You mentioned the Nifty 50 and that was a period of phenomenal returns and a marked period in stock market history. What lessons did you learn from that period? But more importantly, what shouldn't we be careful about applying those lessons perhaps to growth companies today?
Number one, it was a very educational experience for me. It was the experience of my first 10 plus years in the business. If you bought and held the stocks of the best 50 companies in America, you lost almost all your money in a very short time. And in 1978, because I was part of the effort that invested in the Nifty 50, I would imagine I should have come close to losing my job, but rather I was asked to start portfolios in convertible bonds and high yield bonds, which worked out very good and is the core of Oaktree. But now I'm buying the securities of the worst public companies in America, making a lot of money safely and steadily. So the lessons I learned that number one, it's not what you buy, it's what you pay for it that determines whether you'll be successful or not. And number two, successful investing is not a matter of buying good things, it's a matter of buying things well. And I think that's a very important distinction, which has guided the rest of my career. And I guess you only learn lessons from failure. You don't learn much from success. And B, it's great if you learn those lessons early in your career so that they can have a positive influence on your career. But that was the lesson of the Nifty 50, but there are many other lessons to be learned. Number one, a great example of the Nifty 50 was Coca-Cola, a terrific company. It was one of the companies that lost most of its value between mid-1972 and the end of 74. It was another company that had been highly valued and fell to earth. But another important lesson is that Warren Buffett, the high priest of so-called value investing, is perhaps best known for his investment in Coca-Cola, which certainly was not a cigar butt. It was certainly, when he bought it, a great company at a fair price. And even if you bought it at the high in 72, if you held it for the next 26 years, you made a double-digit return for 26 years. And if you can compound your money at a double-digit return for 26 years, you made a lot of money. And Buffett did. And that's one of the stories that is responsible for his success. So I think that's another important lesson. Buffett was not dogmatic about it. He says we don't practice something called growth investing or something called value investing. He didn't make that dichotomy, and I think others shouldn't either.